I don't even know what you're talking about. So here's the stockcharts.com website. So here we go. So the first thing you want to do is for each of your stocks, first thing you want to go up here is to the range and click on 3 years. We're just going to use a 3-year backtest period. Then you need to, where it says overlays right there, it's got to be simple moving average. First one's got to be 10. The second one is 30. And the third one, simple moving average, is going to be 50. And then click update. And here's basically here's the chart. And you might have to blow this up so you can really see the crossover periods. You might have to magnify it to really see the time periods. So here's the key right here. So as you can see, the 50 days, the green right there. And it looks like you were in December of 2015. You had bought the stock, you had bought Apple at, what was it, 100 and, looks like around $115 per share. And then you saw the 10-day cross the 50-day right there, which is your sell alert, and then the red line, which is the 30-day, cross the 50-day, which is your sell. Okay? And you got to put in what you bought it at and what you sold it at. Then, as you can see, this is the green is the 50-day moving average. And the 10 and the 30-day continue to be below the 50-day, so you're just going to hold the stock. And if you shorted the stock, you would have been making a ton of money, or if you bought the puts or wrote the calls. So you might want to think about, from a yield enhancement standpoint, you may want to articulate that also, as a dynamic trading strategy that you've augmented with this moving average crossover system to generate even more monopoly profits. Although we don't have I don't have the system set up to be able to put those derivative trades in there to be able to calculate the amount of money you could have made if you had actually shorted the stock, bought the puts and wrote the calls. Okay. So then, as you can see, there's the 50-day right there, and the 10-day just crossed over the 50-day in March 2016. And then the 30-day crossed the 50-day like the first or second week of March. So you need to record the price at which you bought it for. And then you can see that the 10-day started to turn in April, crossed the 50-day. There's your sell alert. And the 30-day crossed it. There's your sell signal right there. And then it looked like the 10-day almost crossed the 50-day in June, but it didn't. It looks like it finally crossed in July, and then looks like the 30-day crossed in August, and then the 10 and the 30-day continued to stay above the 50-day until about November. And then the 10-day crossed on the downside, then the 30 crossed, there's your sell. But then the 10-day turned around, went up, crossed the 50-day, then the 30-day crossed, and then you got, basically you held all the way through this run-up period. Looks like you sold here, bought it back, sold it here, bought it back, held on to it, sold it here. Oh, you didn't. Actually here, the 10-day crossed, but the 30-day didn't cross. So you were still holding it through this time period. And then it looks like the 10-day crossed, then the 30-day here, you would have sold it. Then you would have bought it back here, held it. It looks like here the 30-day really was sitting on top of the 50-day, and then the 10 and the 30 were well above the 50, and then it looks like you might have sold the 50, the 10 and the 30. It looks like you would have sold the stock at maybe 216. So that would be your trades. And then what you do is you go into the spreadsheet. Now that you've logged on that graph, your sell and your buys and the prices in which you bought and sold, and you basically log the trades over time. You already have from the you can use either the passive strategy, number of initial shares that you bought, or you could use the target portfolio, which you still need to do. Maybe we should talk about that too, because you're going to need to do a target portfolio allocation. How do you come up with the target portfolio allocation? Well, ideally, is you'll conduct the technical analysis and you'll conduct the fundamental analysis. You'll conduct the financial ratio analysis, and you'll figure out what stocks you want to overweight and which ones you want to underweight within the portfolio. The passive strategy just gives you an unbiased allocation of the portfolio. It's unconstrained. Your active strategy is also unconstrained due to the zeros that you got for some of your stocks. But what you may want to decide, what you're going to have to decide, is you're going to have to figure out the minimum and the maximum. Okay? You're going to have to figure out the min and the max. So here you have your passive allocation. Right? And it all adds up to 100%. Then you're going to have your target allocation. Obviously, that's going to add up to 100%. Then you're going to have your active allocation. And I would do a table on this. So the table is going to show you very quickly what your passive portfolio strategy was, what your active portfolio strategy was, and what your reconciled portfolio allocation was. Now might be some stocks in here which you probably should have some kind of minimum allocation for each individual stock. Because if you give a 0 for the stock, it's like, why do you even have it in your portfolio? Okay? You obviously believe in the long-term potential for the stock. That's why you picked it in the first place. So each stock has to have at least a minimum allocation. And I think what we came up with last semester is that they wanted to have at least a minimum of 2% allocation in every single stock. And they didn't want to have more than 10%, and maybe even 8% in any given stock. Because if you're doing, as you know, in your passive allocation, it's going to be Apple and Amazon and those companies that are going to get significantly higher weights because of the market cap if you're using market cap, or even if you're using assets. But in the target, you've got to set the minimum maximum allocations. And then what you're going to do is you're going to look at the passive allocation, you're going to look at your active allocation, and then what I would do is I would reconcile the two approaches to basically come up with some type of preliminary target portfolio allocation, just to get the weights in there, okay? between the two strategies. Then what I would do is I would look at the technical analysis and see if there's any stocks that are in a very strong upward, in some type of strong upward trend. Maybe you've set the supports and the resistance line, looks like they're forming another support right here, you got a resistance there. Maybe you got a pretty strong trend line, and you think that that trend and price momentum will continue into the next year. So you may want to allocate, a little bit more based on the technical analysis. Just basically momentum and trend analysis. And then from your fundamental analysis, what you may want to do is overweight the stocks that are where you're forecasting a premium over the current stock price, and overweight the ones that have significant premiums over their current stock price. And then maybe underweight the stocks that where you're predicting a significant discount to the current stock price. So this, like the other exercises that we went through, you got to go through iterative procedures to get to the final allocation. So again, put in the target, set the minimum maximums, reconcile the two approaches to get a preliminary target portfolio allocation, finish your technical analysis and your fundamental securities analysis, identify the stocks that have very strong upward momentum and trends from a technical standpoint, and then identify the stocks that are trading or will be trading at a significant premium and discount, and overweight the ones that you're forecasting significant premiums, and underweight the ones you're forecasting a significant discount to the current stock price. Then once you finish, the final allocation strategy, then again you update the spreadsheet. You've already back tested and forward tested it, and in the presentation you're going to show us not only this table here, but you're going to give us the performance for the three strategies, the performance for the three, and you're going to sell us on these three strategies as basically the three portfolio strategies in which you're recommending the board to basically approve for single account investments, for ETF product development, and mutual fund product development. Okay? So is everybody clear on what you need to do? What I would do is, what I would probably do is to go ahead and do, you can even write on here, or you can paste on here, maybe save this down as a PDF, capture it and stick it into Word, and start using text boxes in Word to overlay the buy-sell signals and the buy-sell prices. And then what you can do is you can save that Word document down again as a PDF, and then go capture that portion and slap it back into Word. And I would probably have maybe 3 charts per page, no more than 3 on a page, and then have the 25 stocks, 3 per page, put that into a technical securities analysis, moving average crossover section for your appendix. And then we'll refer to it in the reporting document under your technical analysis system. And what you want to show in your report, you probably just want to do a snapshot of maybe 3 stocks so that the investment committee can see the model in which you built to basically generate the profit losses. And then this should be a standalone table right there in your presentation, because it's going to give you exactly how much money you generated total over the 3-year period, but also how much you made on an annual basis, not only on average for 3 years, but each individual year, how much money you generated. And then I would qualify of these trades by saying we could also implement a dynamic strategy, trading strategy, basically going long short the securities, but also writing and buying the derivative contracts to enhance the yield significantly based on the suitability of the client. Because I can sell this to institutional clients, but I can't sell it to some clients because they're unsuitable for this type of dynamic trading strategy. It would have to be a ultra high net worth or high net worth individual, really an ultra high net worth individual or an institutional investor that would do the dynamic trading strategy with the writing and buying of the derivatives and going long short. I could probably sell this straight strategy of buying and selling based on technicals to an accredited investor. I could probably sell that to them as a yield enhancement strategy. Okay, so does everybody understand what they need to do in regards to the technical analysis?
Why would you only do it for ultra high net worth?
The writing and buying of the derivatives?
Is that expensive?
Yeah, you have to have experience in derivative trading to be able to write most of these contracts, particularly writing call options. So you have to have, you really have to be an ultra high net worth or an institutional investor to be able to handle the potential for losses on these things. So I can't sell that dynamic active trading strategy to probably an accredited investor or even a retail investor. It's got to be ultra high net worth with derivative trading experience and institutional investors. It'd be a hard sell. It would be actually a better sell for our selected ultra high net worth clients and our own proprietary trading division. We could do it on our own book. Okay. So here, what I was getting to earlier, is you have to decide what number of shares you're going to put in here. Are you going to put the number of shares from the active strategy, or are you going to do it from the target? What I would do is I would put the passive strategy number of shares in first, and then once you finish the target allocation strategy, at the end of your analysis, go back in, take those numbers of shares that you have allocated and put those in here and update these. Because you've already put in the prices and the trades, that's all you'll do is just change the number of shares that you started out with. And the thing's automatic, it'll just calculate it. Okay? So is everybody clear on how to do the technical analysis, what the strategy is? Okay, let me try this again. Does everybody because I can't read your minds yet, okay? Apple hasn't come up, with an application where I could read your minds yet, okay? So until that time they come up with it, can you tell me, do you understand how to approach the technical analysis here?
Yes.
Okay, great. Does everybody have a technical analyst, or are you going to be working in a team, basically attacking this problem?
Yes.
Okay, great. So let's look at the fundamental securities analysis spreadsheet. Has anybody started working on this? Yep. Okay. So here's your master worksheet. All of this stuff is basically pretty much linked. Okay. Then you have your company inputs here. You're going to have stocks 1 through 6, 7 to 12, 13 to 18, 19 to 24, and the 25th stock. We'll take Apple as an example. All of this is programmed from over here. So if you click on, you don't understand what these things are, you click on the cells and you see where they're basically sourcing from, where they're linked to. So here's the inputs for Apple. Okay. So you're going to stick in the earnings per share. So you have to decide, are you using earnings per share or are you using EBITDA per share? Most of the stocks that I was using were established tech companies that have established EPS. I wasn't doing mid cap or small cap, I was doing large cap. So I had 5 years of data, and I had the earnings per share that were, at that time period, since they're established companies, the earnings per share is pretty stable, okay? So then you gotta put in your 2017 earnings per share. As I said earlier, I was using an 8, 9, and 10% discount rate. You can play with these weights if you wanna reweight them, but as Dakota, Farmer, and I, and the exercises that we went through in 123, we decided we wanted to overweight the DCF model, then the multiple, and then give some weighting, not significant, but some weighting, to the perpetuity and the Gordon growth, okay? And then from that, we would be able to calculate the weighted values and then get the eventual, intrinsic value using the weighted average approach. Again, this should all be pretty much review for those who took my class. For those who didn't take the class, you gotta work with the students, and have me walk you through if you're confused on this stuff, okay? So we basically just took the methodology from the last class and then Dakota programmed it for us to make it a lot easier for us to do it, okay? So here you have your expected returns. In this case, this is obviously, the perpetuity is pretty easy, because if you have the 2018 forecasted earnings per share, you just divide it by the discount rates to get the valuations. That's pretty straightforward. The Gordon growth, we did the same thing, we just took the discount rates. Actually, all that stuff should be linked. So we took the discount rates minus the growth rates, applied that denominator, and got the valuation grid. And then we put in also the multiples for the individual stocks. You can use standardized multiples across all of your stocks, or you can put in custom multiples if you want to. I don't care. It's up to you to decide what you're going to do, but you should use the same discount rates and the same expected returns. So now you have your 2017 cash flow right here. Then you plug in your growth rates right here, and it's going to kick out the earnings per share. And then it's going to calculate the values using the different discount rates. It's going to calculate the terminal value based off of your terminal discount rate and your terminal growth rate that you put in there for the individual stock, and it's going to calculate the present value of the discounted cash flows. The earnings per share is in the terminal value to the present, and that will give you the discounted cash flow intrinsic value. And then as you saw up here, it's going to calculate the weighted shares of those intrinsic values to get the final intrinsic value for the stock. Okay, and then here you got the current stock price, you got the weighted price, and it calculates the premium or the discount right there for you. So you do that 25 times. Okay. Do it 25 times, and then the output grid is here. And you might want to consider printing this summary worksheet out as part of your fundamental securities analysis or intrinsic intrinsic stock valuation section of your appendix. So you're going to have basically printouts of the technical securities analysis, moving average crossover section of your appendix. You're going to have the fundamental securities analysis section of your appendix. So again, you just make sure you print out that stuff, make it look really good, and start building the report. That's the way I do it. Start building to get a draft report going.
Professor, for that company inputs, do we put the stock prices that we put in originally when we started, or should we update them?
You want to do when you calculate the intrinsic, the premium and discount, you would do it as of today.
Okay.
It's the current stock price.
Okay.
So you could use your September 30th, or you could use whatever the most recent period is.
Okay.
Because at some point, you're gonna have to shut off the system, because you've probably already run out of time already.
Right.
So you really can't do like a fourth quarter. You can try, you can do it if you want to.
Mhm.
You know, adding one more spreadsheet to the portfolio spreadsheet to do a kind of a year-end estimate of, of your final forward test.
Okay.
So you could do that if you wanted to do that. Okay. And then, see if I can find the, what I'll have to do is find you the worksheet. Noah Stone did a worksheet for us that basically showed, actually, this might actually be it. Oh yeah, this is it. So the financial ratios worksheet basically takes your stocks, and you have your 25 stocks, here's the ticker, and then it's going to give us the 2016, 17, 18 EPS, the perpetuity, Gordon growth, the multiple, and the DCF valuations along with the intrinsic values. Then you have your current stock price, you have your premium to discount. And then what you're going to do is you're going to sort. And then you have your weights here. And then what you're going to do is you're going to sort this data range right here by premium to discount, and sort the stocks from premium to discount. These are the ones that you're going to overweight in your target portfolio allocation. These are the ones down here that you're going to underweight in your target portfolio allocation based on the fundamental securities analysis. Okay. And then the final chart are the key. Shrikar, did you print out the data set, the financial ratio data set? Yeah.
I haven't done it.
Okay. Anybody do that from Sarah Vatel's the procedures that she walked us through to be able to print out efficiently and effectively the financial ratios for the 25 stocks so that you don't have to do it by hand? Has anybody tried it? Anybody watched the video?
Like Mike was working on it.
Okay. So there's two ways of doing it. One, you could go watch the video, or two, you could go back to Sarah and say, here are the 25 stocks. Will you show me how to print it out? And she'll do it for you. That would be probably, or you just do it by hand. Okay. However you want to do it. And then this last table right here is basically just the financial ratios, but the table's pretty meaningless because it doesn't have the z-score calculations here, or the weighted z-scores. That would create a composite index, and then we would resort the companies based on fundamental financial ratio analysis using the z-score methodology. If somebody, I've been asking this a few times, if somebody wants to come in and work with me to be able to create these composite indexes of weighted z-scores based on the financial ratios to augment your fundamental securities analysis, I will walk you through and I will show you how to do it. Okay? But I need to work with somebody, okay, to do it. And then what you'll do is you'll resort these stocks by the composite z-scores based off of their weighted z-scores of the financial ratios. And that will also give you some fundamental analysis to be able to justify your overweighting and your underweighting schemes for the individual stocks. And I will ask you in the presentation that you make at the end of the semester, I will ask you, how did you come up with the weighting schemes? To walk me through your methodologies on how you came up with the target portfolio allocations. Okay? All right, so anybody have any questions on this? If you do, please contact me. Do not wait too long to start working on this stuff and ask me questions. Okay? All right, so I'm gonna come around and take a look at what you've done so far, if anything.